Chapter 14, Time Cycles. Introduction. Our main focus up to this point has been on price movement, and not too much has been said about the importance of time in solving the forecasting puzzle. The question of time has been present by implication throughout our entire coverage of technical analysis, but has generally been relegated to secondary consideration. In this chapter, we're going to view the problem of forecasting through the eyes of cyclic analysts who believe that time cycles hold the ultimate key to understanding why markets move up or down. In the process, we're going to add the important dimension of time to our growing list of analytical tools. Instead of just asking ourselves which way and how far a market will go, we'll start asking when it will arrive there, or even when the move will begin. Consider the standard daily bar chart. The vertical axis gives the price scale, but that's only half of the relevant data. The horizontal scale gives the time horizon. Therefore, the bar chart is really a time and price chart. Yet many traders concentrate solely on price data to the exclusion of time considerations. When we study chart patterns, we're aware that there is a relationship between the amount of time it takes for those patterns to form and the potential for subsequent market moves. The longer a trend line or a support or resistance level remains in effect, the more valid it becomes. Moving averages require input as to the proper time period to use. Even oscillators require some decision as to how many days to measure. In the previous chapter, we considered the usefulness of Fibonacci time targets. It seems clear then that all phases of technical analysis depend to some extent on time considerations. Yet those considerations are not really applied in a consistent and dependable manner. That's where time cycles come into play. Instead of playing a secondary or supporting role in market movement, cyclic analysts hold that time cycles are the determining factor in bull and bear markets. Not only is time the dominant factor, but all other technical tools can be improved by incorporating cycles. Moving averages and oscillators, for example, can be optimized by tying them to dominant cycles. Trendline analysis can be made more precise with cyclic analysis by determining which are valid trend lines and which are not. Price pattern analysis can be enhanced if combined with cyclic peaks and troughs. By the use of time windows, price movement can be filtered in such a way that extraneous action can be ignored, and primary emphasis placed only on such times when important cycle tops and bottoms are due to occur. Cycles. The most intriguing book I've ever read on the subject of cycles was written by Edward R. Dewey, one of the pioneers of cyclic analysis, with Augmandino entitled Cycles, The Mysterious Forces That Trigger Events. Thousands of seemingly unrelated cycles were isolated spanning hundreds, and in some cases, thousands of years. Everything from the 9.6-year cycle in Atlantic salmon abundance to the 22.2-year cycle in international battles from 1415 to 1930 was tracked. An average cycle of sunspot activity since 1527 was found to be 11.11 years. Several economic cycles, including the 18.33-year cycle in real estate activity and a 9.2-year stock market cycle, were presented. See figures 14.1 and 14.2. Two startling conclusions are discussed by Dewey. First, that many of the cycles of seemingly unrelated phenomena clustered around similar periods. On p. 188 of his book, Dewey listed 37 different examples of the 9.6-year cycle, including caterpillar abundance in New Jersey, coyote abundance in Canada, wheat acreage in the U.S., and cotton prices in the U.S. Why should such unrelated activities show the same cycles? The second discovery was that these similar cycles acted in synchrony, that is, they turned at the same time. Figure 14.3 shows 12 different examples of the 18.2-year cycle, including marriages, immigration, and stock prices in the U.S. Dewey's startling conclusion was that something out there in the universe must be causing these cycles, that there seemed to be a sort of pulse to the universe that accounted for the pervasive presence of these cycles throughout so many areas of human existence. In 1941, Dewey organized the Foundation for the Study of Cycles, 900 W Valley Ardid, Suite 502, Wayne, PA 19087. It is the oldest organization engaged in cycles research and the recognized leader in the field. The Foundation publishes Cycles magazine, which presents research in many different areas, including economics and business. It also publishes a monthly report, Cycle Projections, which applies cyclical analysis to stocks, commodities, real estate, and the economy. Basic cyclic concepts. In 1970, J.M. Hurst authored The Profit Magic of Stock Transaction Timing, Although it deals mainly with stock market cycles, this book represents one of the best explanations of cycle theory available in print and is highly recommended reading. The following diagrams are derived from Hurst's original work. First, let's see what a cycle looks like and discuss its three main characteristics. Figure 14.4 shows two repetitions of a price cycle. The cycle bottoms are called troughs and the tops referred to as crests. Notice that the two waves shown here are measured from trough to trough. Cyclic analysts prefer to measure cycle lengths from low to low. Measurements can be taken between crests, but they are not considered to be as stable or reliable as those taken between the troughs. Therefore, common practice is to measure the beginning and end of a cyclic wave at a low point, as shown in this example. The three qualities of a cycle are amplitude, period, and phase. Amplitude measures the height of the wave, as shown in figure 14.5, and is expressed in dollars, cents, or points. The period of a wave, as shown in figure 14.6, is the time between troughs. In this example, the period is 20 days. The phase is a measure of the time location of a wave trough. In figure 14.7, the phase difference between two waves is shown. Because there are several different cycles occurring at the same time, phasing allows the cyclic analyst to study the relationships between the different cycle lengths. Phasing is also used to identify the date of the last cycle low. If, for example, a 20-day cycle bottomed 10 days earlier, the date of the next cycle low can be determined. Once the amplitude, period, and phase of a cycle are known, the cycle can theoretically be extrapolated into the future. Assuming the cycle remains fairly constant, it can then be used to estimate future peaks and troughs. That is the basis of the cyclic approach in its simplest form. Cyclic principles. Let's take a look now at some of the principles that underlie the cyclic philosophy. The four most important ones are the principles of summation, harmonicity, synchronicity, and proportionality. The principle of summation holds that all price movement is the simple addition of all active cycles. Figure 14.8 demonstrates how the price pattern on the top is formed by simply adding together the two different cycles at the bottom of the chart. Notice in particular the appearance of the double top in composite wave C. Cycle theory holds that all price patterns are formed by the interaction of two or more different cycles. We'll come back to this point again. The principle of summation gives us an important insight into the rationale of cyclic forecasting. Let's assume that all price action is just the sum of different cycle lengths. Assume further that each of those individual cycles could be isolated and measured. Assume also that each of those cycles will continue to fluctuate into the future. Then, by simply continuing each cycle into the future and summing them back together again, the future price trend should be the result. Or so the theory goes. The principle of harmonicity simply means that neighboring waves are usually related by a small whole number. That number is usually 2. For example, if a 20-day cycle exists, the next shorter cycle will usually be half its length, or 10 days. The next longer cycle would then be 40 days. If you'll remember back to the discussion on the 4-week rule, Chapter 9, the principle of harmonics was invoked to explain the validity of using a shorter 2-week rule and a longer 8 weeks. The principle of synchronicity refers to the strong tendency for waves of differing lengths to bottom at about the same time. Figure 14.9 is meant to show both harmonicity and synchronicity. Wave B at the bottom of the chart is half the length of wave A. Wave A includes 2 repetitions of the smaller wave B, showing harmonicity between the two waves. Notice also that when wave A bottoms, wave B tends to do the same, demonstrating synchronicity between the two. Synchronicity also means that similar cycle lengths of different markets will tend to turn together. The principle of proportionality describes the relationship between cycle period and amplitude. Cycles with longer periods, lengths, should have proportionally wider amplitudes. The amplitude, or height, of a 40-day cycle, for example, should be about double that of a 20-day cycle. The principles of variation and nominality. There are 2 other cyclic principles that describe cycle behavior in a more general sense: the principles of variation and nominality. The principle of variation, as the name implies, is a recognition of the fact that all of the other cyclic principles already mentioned, summation, harmonicity, synchronicity, and proportionality, are just strong tendencies and not hard and fast rules. Some variation can and usually does occur in the real world. The principle of nominality is based on the premise that despite the differences that exist in the various markets and allowing for some variation in the implementing of cyclic principles, there seems to be a nominal set of harmonically related cycles that affect all markets. And that nominal model of cycle lengths can be used as a starting point in the analysis of any market. Figure 14.10 shows a simplified version of that nominal model. The model begins with an 18-year cycle and proceeds to each successively lower cycle half its length. The only exception is the relationship between 54 and 18 months, which is a third instead of a half. When we discuss the various cycle lengths in the individual markets, we'll see that this nominal model does account for most cyclic activity. For now, look at the days column. Notice 40, 20, 10, and 5 days. You'll recognize immediately that these numbers account for most of the popular moving average lengths. Even the well-known 4, 9, and 18-day moving average technique is a variation of the 5, 10, and 20-day numbers. Many oscillators use 5, 10, and 20 days. Weekly rule breakouts use the same numbers translated into 2, 4, and 8 weeks. How cyclic concepts help explain charting techniques. Chapter 3 in Hurst's book explains in great detail how the standard charting techniques, trend lines and channels, chart patterns, and moving averages can be better understood and used to greater advantage when coordinated with cyclic principles. Figure 14.11 helps explain the existence of trend lines and channels. The flat cycle wave along the bottom becomes a rising price channel when it is summed with a rising line representing the long-term uptrend. Notice how much the horizontal cycle along the bottom of the chart resembles an oscillator. Figure 14.12 from the same chapter shows how a head and shoulders topping pattern is formed by combining two cycle lengths with a rising line representing the sum of all longer duration components. Hurst goes on to explain double tops, triangles, flags, and pennants through the application of cycles. The V-top or bottom, for example, occurs when an intermediate cycle turns at the exact same time as its next longer and next shorter duration cycles. Hurst also addresses how moving averages can be made more useful if their lengths are synchronized with dominant cycle lengths. Students of traditional charting techniques should gain additional insight into how these popular chart pictures form and maybe even why they work by reading Hurst's chapter, entitled Verify Your Chart Patterns. Dominant cycles. There are many different cycles affecting the financial markets. The only ones of real value for forecasting purposes are the dominant cycles. Dominant cycles are those that consistently affect prices and that can be clearly identified. Most futures markets have at least 5 dominant cycles. In an earlier chapter on the use of long-term charts, it was stressed that all technical analysis should begin with the long-term picture, gradually working toward the shorter term. That principle holds true in the study of cycles. The proper procedure is to begin the analysis with a study of long-term dominant cycles, which can span several years. Then work toward the intermediate, which can be several weeks to several months. Finally, the very short-term cycles, from several hours to several days, can be used for timing of entry and exit points, and to help confirm the turning points of the longer cycles. Classification of cycles. The general categories are long-term cycles, 2 or more years in length, the seasonal cycle, 1 year, the primary or intermediate cycle, 9 to 26 weeks, and the trading cycle, 4 weeks. The trading cycle breaks down into 2 shorter alpha and beta cycles, which average 2 weeks each. The labels primary, trading, alpha, and beta are used by Walt Bressert to describe the various cycle lengths. See Figure 14.13. The Kondratiev wave. There are even longer range cycles at work. Perhaps the best known is the approximate 54-year Kondratiev cycle. This controversial long cycle of economic activity, first discovered by a Russian economist in the 1920s by the name of Nikolai D. Kondratiev, appears to exert a major influence on virtually all stock and commodity prices. In particular, a 54-year cycle has been identified in interest rates, copper, cotton, wheat, stocks, and wholesale commodity prices. Kondratiev tracked his long wave from 1789 using such factors as commodity prices, pig iron production, and wages of agricultural workers in England. See Figure 14.41. The Kondratiev cycle has become a popular subject of discussion in recent years, primarily owing to the fact that its last top occurred in the 1920s, and its next top is long overdue. Kondratiev himself paid a heavy price for his cyclic view of capitalistic economies. He is believed to have died in a Siberian labor camp. For more information, see the long wave cycle. Kondratiev, translated by Guy Daniels. Two other books on the subject are The K-Wave by David Knox Barker and The Great Cycle by Dick Stoken. Combining cycle lengths. As a general rule, long-term and seasonal cycles determine the major trend of a market. Obviously, if a 2-year cycle has bottomed, it can be expected to advance for at least a year, measured from its trough to its crest. Therefore, the long-term cycle exerts major influence on market direction. Markets also have annual seasonal patterns, meaning that they tend to peak or trough at certain times of the year. Grain markets, for example, usually hit their low point around harvest time and rally from there. Seasonal moves usually last for several months. For trading purposes, the weekly primary cycle is the most useful. The 3 to 6 month primary cycle is the equivalent of the intermediate trend, and generally determines which side of a market to trade. The next shorter cycle, the 4-week trading cycle, is used to establish entry and exit points in the direction of the primary trend. If the primary trend is up, troughs in the trading cycle are used for purchases. If the primary trend is down, crests in the trading cycle should be sold short. The 10-day alpha and beta cycles can be used for further fine-tuning. See Figure 14.13. The importance of trend. The concept of trading in the direction of the trend is stressed throughout the body of technical analysis. In an earlier chapter, it was suggested that short-term dips should be used for purchases if the intermediate trend was up, and that short-term bulges be sold in downtrends. In the chapter on Elliott wave theory, it was pointed out that 5-wave moves only take place in the direction of the next larger trend. Therefore, it is necessary when using any short-term trend for timing purposes to first determine the direction of the next longer trend and then trade in the direction of that longer trend. That concept holds true in cycles. The trend of each cycle is determined by the direction of its next longer cycle. Or, stated the other way, once the trend of a longer cycle is established, the trend of the next shorter cycle is known. The 28-day trading cycle in commodities. There is one important short-term cycle that tends to influence most commodity markets, the 28-day trading cycle. In other words, most markets have a tendency to form a trading cycle low every 4 weeks. One possible explanation for this strong cyclic tendency throughout all commodity markets is the lunar cycle. Burton Pugh studied the 28-day cycle in the wheat market in the 1930s. Science and Secrets of Wheat Trading, Lambert Gann, Pomeroy, W.A., 1978, Orrig, 1933, and concluded that the moon had some influence on market turning points. His theory was that wheat should be bought on a full moon and sold on a new moon. Pugh acknowledged, however, that the lunar effects were mild and could be overridden by the effects of longer cycles or important news events. Left and right translation. The concept of translation may very well be the most useful aspect of cycle analysis. Left and right translation refers to the shifting of the cycle peaks either to the left or the right of the ideal cycle midpoint. For example, a 20-day trading cycle is measured from low to low. The ideal peak should occur 10 days into the cycle or at the halfway point. That would allow for a 10-day advance followed by a 10-day decline. Ideal cycle peaks, however, rarely occur. Most variations in cycles occur at the peaks or crests and not at the troughs. That's why cycle troughs are considered more reliable and are used to measure cycle lengths. The cycle crests act differently depending on the trend of the next longer cycle. If the trend is up, the cycle crest shifts to the right of the ideal midpoint, causing right translation. If the longer trend is down, the cycle crest shifts to the left of the midpoint, causing left translation. Therefore, right translation is bullish and left translation is bearish. Stop to think about it. All we're saying here is that in a bull trend, prices will spend more time going up than down. In a bear trend, prices spend more time going down than up. Isn't that the basic definition of a trend? Only in this case, we're talking about time instead of price. See Figure 14.15. How to isolate cycles. In order to study the various cycles affecting any given market, it is necessary to first isolate each dominant cycle. There are various ways of accomplishing this task. The simplest is by visual inspection. By studying daily bar charts, for example, it is possible to identify obvious tops and bottoms in a market. By taking the average time periods between those cyclic tops and bottoms, certain average lengths can be found. There are tools available to make that task a bit easier. One such tool is the Ehrlich Cycle Finder, named after its inventor, Stan Ehrlich, ECF 102 Vita Court, Novato, CA 94947, 415-892-1183. The Cycle Finder is an accordion-like device that can be placed on the price chart for visual inspection. The distance between the points is always equidistant and can be expanded or contracted to fit any cycle length. By plotting a distance between any two obvious cycle lows, it can be quickly determined if other cycle lows of the same length exist. An electronic version of that device, called the Ehrlich Cycle Forecaster, is now available as an analysis technique on Omega Research's TradeStation and Supercharts. Omega Research, 8700 West Flagler Street, Suite 250, Miami, FL 33774. 305-551-9991, www.omegaresearch.com. See Figures 14.6-4.18. Computers can help you find cycles by visual inspection. The user first puts a price chart on the screen. The next step is to pick a prominent bottom on the chart as a starting point. Once that is done, vertical lines or arcs appear every 10 days, the default value. The cycle periods can be lengthened, shortened, or moved left or right to find the right cycle fit on the chart. See Figures 14.19 and 14.20. Seasonal cycles. All markets are affected to some extent by an annual seasonal cycle. The seasonal cycle refers to the tendency for markets to move in a given direction at certain times of the year. The most obvious seasonals involve the grain markets, where seasonal lows usually occur around harvest time when supply is most plentiful. In soybeans, for example, most seasonal tops occur between April and June, with seasonal bottoms taking place between August and October. See Figure 14.21. One well-known seasonal pattern is the February break, where grain and soybean prices usually drop from late December or early January into February. Although the reasons for seasonal tops and bottoms are more obvious in the agricultural markets, virtually all markets experience seasonal patterns. Copper, for example, shows a strong seasonal uptrend from the January-February period with a tendency to top in March or April. See Figure 14.22. Silver has a low in January with higher prices into March. Gold shows a tendency to bottom in August. Petroleum products have a tendency to peak during October and usually don't bottom until the end of the winter. See Figure 14.23. Financial markets also have seasonal patterns. The US dollar has a tendency to bottom during January. See Figure 4.24. Treasury bond prices usually hit important highs during January. Over the entire year, Treasury bond prices are usually weaker during the first half of the year and stronger during the second half. See Figure 14.25. The examples of seasonal charts are provided by the Moore Research Center. Moore Research Center, 321 West 13th Avenue, Eugene, OR 97401, 800-927-7259, which specializes in seasonal analysis of futures markets. Stock market cycles. Did you know that the strongest 3-month span for the stock market is November through January? February is then weaker, but is followed by a strong March and April. After a soft June, the market turns strong during July, the start of the traditional summer rally. The weakest month of the year is September. The strongest month is December, ending with the well-known Santa Claus rally just after Christmas. That information and a whole lot more about stock market cycles can be found in Yale Hirsch's annual Stock Traders Almanac, the Hirsch Organization, 184 Central Avenue, Old Tappan, NJ 07675. The January Barometer. According to Hirsch, as January goes, so goes the year. The well-known January Barometer holds that what the S&P 500 does during January will determine what kind of year the market as a whole will have. Another variation on that theme is the belief that the direction of the S&P 500 during the first 5 trading days of the year gives some hint of what's ahead for the year. The January Barometer shouldn't be confused with the January effect, which is the tendency for smaller stocks to outperform larger stocks during January. The presidential cycle. Another well-known cycle that affects stock market behavior is the 4-year cycle, also called the presidential cycle, because it coincides with the elected term of U.S. presidents. Each of the 4 years has a different historical return. The election year, 1, is normally strong. The post-election and mid-years, 2 and 3, are normally weak. The pre-election year, 4, is normally strong. According to Hirsch's Traders Almanac, election years since 1904 have seen average gains of 224%, post-election years, gains of 72%, midterm years, gains of 63%, and pre-election years, gains of 217%. See Figure 14.16. Combining cycles with other technical tools. Two of the most promising areas of overlap between cycles and traditional technical indicators are in the use of moving averages and oscillators. It is believed that the usefulness of both indicators can be enhanced if the time periods used are tied to each market's dominant cycles. Let's assume that a market has a dominant 20-day trading cycle. Normally, when constructing an oscillator, it's best to use half the length of the cycle. In this case, the oscillator period would be 10 days. To trade a 40-day cycle, use a 20-day oscillator. Walt Bressert discusses in his book, The Power of Oscillator Cycle Combinations, how cycles can be used to adjust time spans for the Commodity Channel Index, the Relative Strength Index, stochastics, and Moving Average Convergence Divergence, MACD. Moving averages can also be tied to cycles. You could use different moving averages to track different cycle lengths. To generate a moving average crossover system for a 40-day cycle, you could use a 40-day moving average in conjunction with a 20-day average, 1/2 of the 40-day cycle, or a 10-day average, 1/4 of the 40-day cycle. The main problem with this approach is determining what the dominant cycles are at a particular point in time. Maximum entropy spectral analysis. The search for the right dominant cycles in any market is complicated by the belief that cycle lengths aren't static. In other words, they keep changing over time. What worked a month ago may not work a month from now. In his book, MESA and Trading Market Cycles, John Ehlers uses a statistical approach called Maximum Entropy Spectral Analysis, MESA. Ehlers explains that one of the main advantages of MESA is its high-resolution measurement of cycles with relatively small time periods, which is crucial for shorter-term trading. Ehlers also explains how cycles can be used to optimize moving average lengths and many of the oscillator-type indicators we've already mentioned. Uncovering cycles allows for the dynamic adjusting of technical indicators to fit current market conditions. Ehlers also addresses the problem of distinguishing between a market in a cycle mode versus one that is in a trend mode. When a market is in a trend mode, a trend-following indicator, like a moving average, is needed to implement trades. A cycle mode would favor the use of oscillator-type indicators. Cycle measurement can help determine which mode the market is currently in and which type of technical indicator is more appropriate to use for trading strategies. Cycle reading and software. Most of the books referred to in this chapter on cycles can be obtained through mail order firms like Traders Press, see reference in previous chapter, or Traders Library, P.O. Box 2466, Ellicott City, MD 21041, 800-272-2855. There's also a lot more software to help you perform cycle analysis with your computer. The Ehrlich Cycle Forecaster and Walt Bressert's Cycle Trader are both available as add-on options to run with charting software provided by Omega Research. Bressert's Cycle Trader integrates the concepts he describes in his book, The Power of Oscillator Cycle Combinations. Bressert Marketing Group, 100 East Walton, Suite 200, Chicago, IL 6611, 312-867-8701. More information on the MESA computer program can be gotten from John Ehlers, Box 1801, Goleta, CA 93116, 805-969-6478. For ongoing cycle research and analysis, don't forget the Foundation for the Study of Cycles. End of Chapter 14. Chapter 15, Computers and Trading Systems. Introduction. The computer has played an increasingly important role in the field of technical analysis. In this chapter, we'll see how the computer can make the technical trader's task a good deal easier by providing quick and easy access to an arsenal of technical tools and studies that would have required an enormous amount of work just a few years earlier. This assumes, of course, that the trader knows how to use these tools, which brings us to one of the disadvantages of the computer. The trader not properly schooled in the concepts that underlie the various indicators, and who is not comfortable with how each indicator is interpreted, may find him or herself overwhelmed with the vast array of computer software currently available. Even worse, the amount of impressive technical data at one's fingertips sometimes fosters a false sense of security and competence. Traders mistakenly assume that they are automatically better simply because they have access to so much computer power. The theme emphasized in this discussion is that the computer is an extremely valuable tool in the hands of a technically oriented trader who has already done his or her basic homework. When we review many of the routines available in the computer, you'll see that a fair number of the tools and indicators are quite basic and have already been covered in previous chapters. There are, of course, more sophisticated tools that require more advanced charting software. Much of the work involved in technical analysis can be performed without the computer. Certain functions can be more easily performed with a simple chart and ruler than with a computer printout. Some types of longer-range analysis don't require a computer. As useful as it is, the computer is only a tool. It can make a good technical analyst even better. It won't, however, turn a poor technician into a good one. Charting software. Several of the technical routines available in charting software have been covered in previous chapters. We'll review some of the tools and indicators currently available. We'll then address some additional features, such as the ability to automate the various functions chosen by the user. In addition to providing us with the various technical studies, the computer also enables us to test various studies for profitability, which may be the most valuable feature of the program. Some software allows the user with little or no programming background to construct indicators and systems. Welles-Wilder's directional movement and parabolic systems. We'll take a close look at a couple of Welles-Wilder's more popular systems, the directional movement system and the parabolic system. We'll use those two systems in our discussion of the relative merits of relying on mechanical trading systems. It will be demonstrated that mechanical trend-following systems only work well in certain types of market environments. It will also be shown how a mechanical system can be incorporated into one's market analysis and used simply as a confirming technical indicator. Too much of a good thing. It may strike you that there are too many indicators from which to choose. Instead of simplifying our lives, has the computer only served to complicate things by giving us so much more to look at? Charting packages offer 80 different studies that are available to the technician. How does one possibly reach any conclusions and find the time to trade with so much data to contend with? We'll say a few words about some work being done in that direction. Some computer needs. Charting software can be applied to virtually any financial market. Most software is user-friendly, meaning that it can be easily implemented by choosing from successive lists of available routines. The place to start is with a charting software package that works for the computer you already own or are thinking of buying. Bear in mind that most charting software has been written for IBM-compatible computers. Charting packages do not provide daily market data. The user must obtain that data elsewhere. Data can be collected automatically from a data service over telephone lines, requiring a phone modem. Charting packages provide the names of various data vendors from which to choose. These data vendors provide all the software and instructions needed to set up and collect the data files. When first starting out, the user must collect historical data going back for at least several months to have something to work with. After that, data should be collected daily. It is possible to analyze online data during the trading day by hooking up to a quote service. However, in our use of daily data, we will be referring to end-of-day data, which is available after the markets close. The final piece of equipment you might want is a printer to obtain a copy of whatever appears on the terminal screen. CD-ROM capability is highly recommended, since some software vendors provide you with several years of historical data on a CD-ROM disk to get you started. There are some data vendors that also provide charting capability, which simplifies your task even more. One such service is Telescan, 5959 Corporate Drive, Suite 2000, Houston, TX77036, 800-304-8246.telescan.com. Grouping tools and indicators. The following list groups some of the chart and indicator options. Basic charts, bar, line, point and figure, and candlesticks. Chart scales, arithmetic and semi-logarithmic. Bar chart, price, volume, and open interest for futures. Volume, bars, on balance, and demand index. Basic tools, trend lines and channels, percentage retracements, moving averages, and oscillators. Moving averages, reference envelopes, Bollinger Bands, oscillators, commodity channel index, momentum, rate of change, MACD, stochastic, Williamson R, RSI. Cycles, cycle finder, Fibonacci tools, fan lines, arcs, time zones, and retracements. Wilder, RSI, commodity selection index, directional movement, parabolic swing index, ADX line. Using the tools and indicators. How does one cope with so much from which to choose? A suggestion is to first use the basic tools such as price, volume, trend lines, percentage retracements, moving averages, and oscillators. Notice the large number of oscillators available. Pick one or two that you are most comfortable with and go with them. Use such things as cycles and Fibonacci tools as secondary inputs unless you have a special interest in those areas. Cycles can help fine-tune moving average and oscillator lengths, but require study and practice. For mechanical trading systems, Wilder's parabolic and DMI are especially noteworthy. Wells-Wilder's parabolic and directional movement systems. We're going to spend some time on two studies that are especially useful. Both studies were developed by J. Wells Wilder Jr. and discussed in his book, New Concepts in Technical Trading Systems. Three of Wilder's other studies included on the computer menu. Commodity Selection Index, Relative Strength Index, and the Swing Index are also included in the same book. Parabolic System, SAR. Wilder's parabolic system, SAR, is a time price reversal system that is always in the market. The letters SAR stand for stop and reverse, meaning that the position is reversed when the protective stop is hit. It is a trend-following system. It gets its name from the shape assumed by the trailing stops that tend to curve like a parabola. See figures 15.1 to 15.4. Notice that as prices trend higher, the rising dots below the price action, the stop and reverse points, tend to start out slower and then accelerate with the trend. In a downtrend, the same thing happens, but in the opposite direction. The dots are above the price action. The SAR numbers are calculated and available to the user for the following day. Wilder built an acceleration factor into the system. Each day, the stop moves in the direction of the new trend. At first, the movement of the stop is relatively slow to allow the trend time to become established. As the acceleration factor increases, the SAR begins to move faster, eventually catching up to the price action. If the trend falters or fails to materialize, the result is usually a stop and reverse signal. As the accompanying charts show, the parabolic system works extremely well in trending markets. Notice that while the trending portions were captured well, the system whipsawed constantly during the sideways, non-trending periods. That demonstrates both the strength and weakness of most trend-following systems. They work well during strong trending periods, which Wilder himself estimates occur only about 30% of the time. If that estimate is even close to reality, then a trend-following system will not work for about 70% of the time. How then does one deal with this problem? DMI and ADX. One possible solution is to use some type of filter or a device to determine if the market is in a trending mode. Wilder's ADX line rates the directional movement of the various markets on a scale of 0 to 100. A rising ADX line means the market is trending and a better candidate for a trend-following system. A falling ADX line indicates a non-trending environment, which would not be suitable for a trend-following approach. See figure 15.5. Because the ADX line is on a scale from 0 to 100, the trend trader could simply trade those markets with the highest trend ratings. Non-trending systems, oscillators for example, could be utilized on markets with low directional movement. Directional movement can be used either as a system on its own or as a filter on the parabolic or any other trend-following system. Two lines are generated in the DMI study, plus DI and minus DI. The first line measures positive, upward movement, and the second number, negative, downward movement. Figure 15.6 shows the two lines. The darker line is plus DI and the lighter line DI. A buy signal is given when the plus DI line crosses over the dash DI line, and a sell signal when it crosses below the DI line. Figure 15.6 also shows both the parabolic and directional movement systems. The parabolic is clearly a more sensitive system, meaning that more frequent and earlier signals are given. However, by using the directional movement as a filter, several of the bad signals in the parabolic could be avoided by following only those signals in the same direction as the directional movement lines. It appears then that the parabolic and directional movement systems should be used together, with directional movement acting as a screen or filter on the more sensitive parabolic. The best time to use a trending system is when the ADX line is rising. See figures 15.7 and 15.8. Be forewarned, however, that when the ADX line starts to drop from above the 40 level, that is an early sign that the trend is weakening. A rise back above the 20 level is often a sign of the start of a new trend. The ADX line is essentially a smooth difference between the plus DI and DI lines. Pros and cons of system trading. Advantages of mechanical systems. 1. Human emotion is eliminated. 2. Greater discipline is achieved. 3. More consistency is possible. 4. Trades are taken in the direction of the trend. 5. Participation is virtually guaranteed in the direction of every important trend. 6. Profits are allowed to run. 7. Losses are minimized. Disadvantages of mechanical systems. 1. Most mechanical systems are trend following. 2. Trend following systems rely on major trends in order to be profitable. 3. Trend following systems are generally non-profitable when markets are not trending. 4. There are long periods of time when markets are not trending and therefore not suitable for a trending approach. The major problem is the failure of the system to recognize when the market is not trending and its inability to turn itself off. The measure of a good system is not only its ability to make money in trending markets, but its ability to preserve capital during non-trending periods. It is this inability of the system to monitor itself that is its greatest weakness. This is where some overriding filtering device, such as Wells-Wilder's directional movement system or the ADX line, could prove especially useful by allowing the trader to determine which markets are most suitable for a trending system. Another drawback is that no allowance is generally made for anticipating market reversals. Trend-following systems ride with the trend until it turns. They don't recognize when a market has reached a long-term support or resistance level, when oscillator divergences are being given, or when an Elliott wave fifth pattern is clearly visible. Most traders would get more defensive at that point and begin taking some profits. The system, however, will stay with the position until well after the market has changed direction. Therefore, it's up to the trader to determine how best to employ the system. That is to say, whether it should be followed blindly or whether it should be incorporated into a trading plan with other technical factors. That brings us to our next section on how a mechanical system can be used as just another technical input into the forecasting and trading process. Using system signals as a disciplining device. The system signals can be used simply as a mechanical confirmation along with other technical factors. Even if the system is not being traded mechanically and other technical factors are being employed, the signals could be used as a disciplined way to keep the trader on the right side of the major trend. No short positions would be taken as long as the computer trend was up. No longs would be taken in a computer downtrend. This would be a simple way for fundamentally oriented traders to use a technical device as a filter or trigger on their own trading ideas. Trend direction can be a matter of judgment. The computer signals relieve the trader of some degree of uncertainty. They can prevent him or her from falling into the trap of top and bottom picking, using signals as alerts. System signals can also be used as an excellent screening device to alert the trader to recent trend changes. The trader can simply glance at the trend signals and instantly has several trading candidates. The same information could be found by studying all of the charts. The computer just makes that task quicker, easier, and more authoritative. The ability of the computer to automate system signals and then alert the trader when signals are triggered is an enormous asset, especially when the universe of financial markets has grown so large. Need expert help? One of the products offered by Omega Research, called TradeStation, offers a variety of expert features. Omega Research, Miami, FL 33174, 305-551-9991. You can call up its expert commentary, which interprets indicators for you based on current market conditions. Omega's expert analyst will determine which indicators should work best in the current market and interpret them for you. In addition, it has 2 expert tools. The Trendlines Automatic Indicator actually draws trend lines for you. The Candlestick Patterns Indicator reads the more common candlestick chart patterns. Test systems or create your own. Omega Research also includes a library of the most popular trading systems used by traders. You can test them, change them, or create your own if you wish. All of Omega's charting tools, indicators, and trading systems are written in a relatively simple language called Easy Language. Easy Language takes trading ideas that you have described in plain language and converts them into the machine code needed to run the program. It's hard to overestimate the value of being able to develop, test, optimize, if you wish, and then automate your own trading ideas without being a computer programmer. The computer will even generate the appropriate trading orders for you and alert you via your alphanumeric pager that signals have been triggered. In Appendix C, we'll use Omega Research's Easy Language and TradeStation to show you to go about creating a trading system of your own. Conclusion. This chapter introduced a couple more of Wells-Wilder's systems to you. Parabolics and directional movement, DMI. Parabolics can generate useful trading signals, but probably shouldn't be used alone. The two DL lines can be used as a filter on parabolics or any other sensitive trend-following trading system. The ADX line, which is part of the DMI system, provides one way to determine which type of market you're dealing with, a trending or a trading market. A rising ADX line suggests a trend and favors moving averages. A falling ADX line suggests a trading range and favors oscillators. We also use the parabolic examples to show the good and bad sides of most trend-following systems. They work well when a trend is present. They're useless during a trading range. You have to be able to tell the difference. We also touched on the merits of mechanical trading systems. These systems remove human emotion and can be very helpful in the right market climate. They can also be used as technical alerts and used in conjunction with fundamental analysis. See Appendix C for more on system trading. There's no question that the computer has revolutionized financial market analysis and trading. While our interest is primarily in technical analysis, software programs also allow you to blend fundamental analysis with the technical. When the first edition of this book was published in 1986, it cost about $5,000 to outfit yourself with the necessary computer hardware to perform serious technical analysis. The leading software package of the day cost close to $2,000. How things have changed. You can now obtain incredibly powerful computers for less than $2,000. Most software packages can be had for less than $300. The better ones provide you with up to 20 years of historical price data on a CD-ROM disk at little or no additional cost. Another big benefit is the amount of educational help that you can obtain with those software packages. The user manuals alone are the size of a book and include technical formulas and all kinds of useful explanations. The screening and alert capabilities of today's computer are especially helpful to those monitoring global bond and stock markets and thousands of individual common stocks, not to mention mutual funds. In Chapter 17, we'll talk about an even more sophisticated use of computer technology for developing neural networks. But the message to you is clear. If you are serious about investing or trading financial markets, get a computer and learn how to use it. You'll be glad you did. End of Chapter 15. Chapter 16, Money Management and Trading Tactics. Introduction. The previous chapters presented the major technical methods used to forecast and trade financial markets. In this chapter, we'll round out the trading process by adding to the task of market forecasting the crucial elements of trading tactics, or timing, and the often overlooked aspect of money management. No trading program can be complete without all three elements. The three elements of successful trading. Any successful trading program must take into account three important factors: price forecasting, timing, and money management. 1. Price forecasting indicates which way a market is expected to trend. It is the crucial first step in the trading decision. The forecasting process determines whether the trader is bullish or bearish. It provides the answer to the basic question of whether to enter the market from the long or short side. If the price forecast is wrong, nothing else that follows will work. 2. Trading tactics, or timing, determines specific entry and exit points. Timing is especially crucial in futures trading. Because of the low margin requirements and the resulting high leverage, there isn't much room for error. It's quite possible to be correct on the direction of the market, but still lose money on a trade if the timing is off. Timing is almost entirely technical in nature. Therefore, even if the trader is fundamentally oriented, technical tools must be employed at this point to determine specific entry and exit points. 3. Money management covers the allocation of funds. It includes such areas as portfolio makeup, diversification, how much money to invest or risk in any one market, the use of stops, reward-to-risk ratios, what to do after periods of success or adversity, and whether to trade conservatively or aggressively. The simplest way to summarize the three different elements is that price forecasting tells the trader what to do, buy or sell, timing helps decide when to do it, and money management determines how much to commit to the trade. The subject of price forecasting has been covered in the previous chapters. We'll deal with the other two aspects here. We'll discuss money management first, because that subject should be taken into consideration when deciding on the appropriate trading tactics. Money management. After having spent many years in the research department of a major brokerage firm, I made the inevitable switch to managing money. I quickly discovered the major difference between recommending trading strategies to others and implementing them myself. What surprised me was that the most difficult part of the transition had little to do with market strategies. The way I went about analyzing the markets and determining entry and exit points didn't change much. What did change was my perception of the importance of money management. I was amazed at the impact such things as the size of the account, the portfolio mix, and the amount of money committed to each trade could have on the final results. Needless to say, I am a believer in the importance of money management. The industry is full of advisors and advisory services telling clients what to buy or sell and when to do it. Very little is said about how much of one's capital to commit to each trade. Some traders believe that money management is the most important ingredient in a trading program, even more crucial than the trading approach itself. I'm not sure I'd go that far, but I don't think it's possible to survive for long without it. Money management deals with the question of survival. It tells the trader how to handle his or her money. Any good trader should win in the long run. Money management increases the odds that the trader will survive to reach the long run. Some general money management guidelines. Admittedly, the question of portfolio management can get very complicated, requiring the use of advanced statistical measures. We'll approach it here on a relatively simple level. The following are some general guidelines that can be helpful in allocating one's funds and in determining the size of one's trading commitments. These guidelines refer primarily to futures trading. Number 1. Total invested funds should be limited to 50% of total capital. The balance is placed in treasury bills. This means that at any one time, no more than half of the trader's capital should be committed to the markets. The other half acts as a reserve during periods of adversity and drawdown. If, for example, the size of the account is $100, only $50,000 would be available for trading purposes. Number 2. Total commitment in any one market should be limited to 10 to 15% of total equity. Therefore, in a $100,000 account, only $10,000 to $15,000 would be available for margin deposit in any one market. This should prevent the trader from placing too much capital in any one trade. 3. The total amount risked in any one market should be limited to 5% of total equity. This 5% refers to how much the trader is willing to lose if the trade doesn't work. This is an important consideration in deciding how many contracts to trade and how far away a protective stop should be placed. A $100,000 account, therefore, should not risk more than $5,000 on a single trade. 4. Total margin in any market group should be limited to 20 to 25% of total equity. The purpose of this criteria is to protect against getting too heavily involved in any one market group. Markets within groups tend to move together. Gold and silver are part of the precious metals group and usually trend in the same direction. Putting on full positions in each market in the same group would frustrate the principle of diversification. Market commitments in the same group should be controlled. These guidelines are fairly standard in the futures industry, but can be modified to the trader's needs. Some traders are more aggressive than others and take bigger positions. Others are more conservative. The important consideration is that some form of diversification be employed that allows for preservation of capital and some measure of protection during losing periods. Although these guidelines relate to futures trading, the general principles of money management and asset allocation be applied to all forms of investing. Diversification versus concentration. While diversification is one way to limit risk exposure, it can be overdone. If a trader has trading commitments in too many markets at the same time, a few profitable trades may be diluted by a larger number of losing trades. A trade-off exists, and the proper balance must be found. Some successful traders concentrate their trading in a handful of markets. That's fine as long as those markets are the ones that are trending at that time. The more negative correlation between the markets, the more diversification is achieved. Holding long positions in 4 foreign currency markets at the same time would not be a good example of diversification, since foreign currencies usually trend in the same direction against the US dollar. Using protective stops. I strongly recommend the use of protective stops. Stop placement, however, is an art. The trader must combine technical factors on the price chart with money management considerations. We'll show how this is done later in the chapter in the section on tactics. The trader must consider the volatility of the market. The more volatile the market is, the looser the stop that must be employed. Here again, a trade-off exists. The trader wants the protective stop to be close enough so that losing trades are as small as possible. Protective stops placed too close, however, may result in unwanted liquidation on short-term market swings or noise. Protective stops placed too far away may avoid the noise factor, but will result in larger losses. The trick is to find the right middle ground. Reward to risk ratios. The best futures traders make money on only 40% of their trades. That's right. Most trades wind up being losers. How then do traders make money if they're wrong most of the time? Because futures contracts require so little margin, even a slight move in the wrong direction results in forced liquidation. Therefore, it may be necessary for a trader to probe a market several times before catching the move he or she is looking for. This brings us to the question of reward to risk ratios. Because most trades are losers, the only way to come out ahead is to ensure that the dollar amount of the winning trades is greater than that of the losing trades. To accomplish this, most traders use a reward to risk ratio. For each potential trade, a profit objective is determined. That profit objective, the reward, is then balanced against the potential loss if the trade goes wrong, the risk. A commonly used yardstick is a 3-to-1 reward to risk ratio. The profit potential must be at least 3 times the possible loss if a trade is to be considered. Letting profits run and cutting losses short is one of the oldest maxims of trading. Large profits in trading are achieved by staying with persistent trends. Because only a relative handful of trades during the course of a year will generate large profits, it's necessary to maximize those few big winners. Letting profits run is the way that is done. The other side of the coin is to keep losing trades as small as possible. You'd be surprised how many traders do just the opposite, trading multiple positions, trending versus trading units. Letting profits run isn't as easy as it sounds. Picture a situation where a market starts to trend, producing large profits in a relatively short period of time. Suddenly, the trend stalls. The oscillators show an overbought situation, and there's some resistance visible on the chart. What to do? You believe the market has much higher potential, but you're worried about losing your paper profits if the market should fail. Do you take profits or ride out a possible correction? One way to resolve that problem is to always trade in multiple units. Those units can be divided into trading and trending positions. The trending portion of the position is held for the long pull. Loose protective stops are employed, and the market is given plenty of room to consolidate or correct itself. These are the positions that produce the largest profits in the long run. The trading portion of the portfolio is earmarked for shorter-term in and out trading. If the market reaches a first objective, is near resistance and overbought, some profits could be taken or a tight protective stop utilized. The purpose is to lock up or protect profits. If the trend then resumes, any liquidated positions can be reinstated. It's best to avoid trading only one unit at a time. The increased flexibility that is achieved from trading multiple units makes a big difference in overall trading results. What to do after periods of success and adversity? What does a trader do after a losing or a winning streak? Suppose your trading equity is down by 50%. Do you change your style of trading? If you've already lost half of your money, you now have to double what you have remaining just to get back to where you were in the first place. Do you get more selective choosing trades or keep doing the same things you were doing before? If you become more conservative, it will be that much harder to win back your losses. A more pleasant dilemma occurs after a winning streak. What do you do with your winnings? Suppose you've doubled your money. One alternative is to put your money to maximum use by doubling the size of your positions. If you do that, however, what will happen during the inevitable losing period that's sure to follow? Instead of giving back 50% of your winnings, you'll wind up giving it all back. So the answers to these two questions aren't as simple or obvious as they might first appear. Every trader's track record is a series of peaks and troughs, much like a price chart. The trend of the equity chart should be pointing upward if the trader is making money on balance. The worst time to increase the size of one's commitments is after a winning streak. That's much like buying into an overbought market in an uptrend. The wiser thing to do, which goes against basic human nature, is to begin increasing one's commitments after a dip in equity. This increases the odds that the heavier commitments will be made near the equity troughs instead of the peaks. Trading tactics. Upon completion of the market analysis, the trader should know whether he or she wants to buy or sell the market. By this time, money management considerations should have dictated the level of involvement. The final step is the actual purchase or sale. This can be the most difficult part of the process. The final decision as to how and where to enter the market is based on a combination of technical factors, money management parameters, and the type of trading order to employ. Let's consider them in that order. Using technical analysis in timing. There's nothing really new in applying the technical principles discussed in previous chapters to the timing process. The only real difference is that timing covers the very short term. The time frame that concerns us here is measured in days, hours, and minutes, as opposed to weeks and months. But the technical tools employed remain the same. Rather than going through all of the technical methods again, we'll limit our discussion to some general concepts. 1. Tactics on breakouts. 2. The breaking of trend lines. 3. The use of support and resistance. 4. The use of percentage retracements. 5. The use of gaps. Tactics on breakouts. Anticipation or reaction. The trader is forever faced with the dilemma of taking a position in anticipation of a breakout, taking a position on the breakout itself, or waiting for the pullback or reaction after the breakout occurs. There are arguments in favor of each approach or all three combined. If the trader is trading several units, one unit can be taken in each instance. If the position is taken in anticipation of an upside breakout, the payoff is a better, lower price if the anticipated breakout takes place. The odds of making a bad trade, however, are increased. Waiting for the actual breakout increases the odds of success, but the penalty is a later, higher entry price. Waiting for the pullback after the breakout is a sensible compromise, providing the pullback occurs. Unfortunately, many dynamic markets, usually the most profitable ones, don't always give the patient trader a second chance. The risk involved in waiting for the pullback is the increased chance of missing the market. This situation is an example of how trading multiple positions simplifies the dilemma. The trader could take a small position in anticipation of the breakout, buy some more on the breakout, and add a little more on the corrective dip following the breakout. The breaking of trend lines. This is one of the most useful early entry or exit signals. If the trader is looking to enter a new position on a technical sign of a trend change or a reason to exit an old position, the breaking of a tight trend line is often an excellent action signal. Other technical factors must, of course, always be considered. Trend lines can also be used for entry points when they act as support or resistance. Buying against a major uptrend line or selling against a downtrend line can be an effective timing strategy. Using support and resistance. Support and resistance are the most effective chart tools to use for entry and exit points. The breaking of resistance can be a signal for a new long position. Protective stops can then be placed under the nearest support point. A closer protective stop could be placed just below the actual breakout point, which should now function as support. Rallies to resistance in a downtrend or declines to support in an uptrend can be used to initiate new positions or add to old profitable ones. For purposes of placing protective stops, support and resistance levels are most valuable. Using percentage retracements. In an uptrend, pullbacks that retrace 40 to 60% of the prior advance can be utilized for new or additional long positions. Because we're talking primarily about timing, percentage retracements can be applied to very short-term action. A 40% pullback after a bullish breakout, for example, might provide an excellent buying point. Bounces of 40 to 60% usually provide excellent shorting opportunities in downtrends. Percentage retracements can be used on intraday charts also. Using price gaps. Price gaps on bar charts can be used effectively in the timing of purchases or sales. After an up move, for example, underlying gaps usually function as support levels. Buy a dip to the upper end of the gap or a dip into the gap itself. A protective stop can be placed below the gap. In a bear move, sell a rally to the lower end of the gap or into the gap itself. A protective stop can be kept over the gap. Combining technical concepts. The most effective way to use these technical concepts is to combine them. Remember that when we're discussing timing, the basic decision to buy or sell has already been made. All we're doing here is fine-tuning the entry or exit point. If a buy signal has been given, the trader wants to get the best price possible. Suppose prices dip into the 40-60% buying zone, show a prominent support level in that zone, and or have a potential support gap. Suppose further that a significant uptrend line is nearby. All of these factors used together would improve the timing of the trade. The idea is to buy near support, but to exit quickly if that support is broken. Violation of a tight downtrend line drawn above the highs of a downside reaction could also be used as a buying signal. During a bounce in a downtrend, the breaking of a tight uptrend line could be a shorting opportunity. Combining technical factors and money management. Besides using chart points, money management guidelines should play a role in how protective stops are set. Assuming an account size of $100,000 and using the 10% criteria for maximum commitment, only $10,000 is available for the trade. The maximum risk is 5%, or $5,000. Therefore, protective stops on the total position must be placed in such a way that no more than $5,000 would be lost if the trade doesn't work. A closer protective stop would permit the taking of larger positions. A looser stop would reduce the size of the position. Some traders use only money management factors in determining where to place a protective stop. It's critically important, however, that the protective stop be placed over a valid resistance point for a short position or below a valid support point for a long position. The use of intraday charts can be especially effective in finding closer support or resistance levels that have some validity. Types of trading orders. Choosing the right type of trading order is a necessary ingredient in the tactical process. We'll concern ourselves only with some of the more common types of orders: market, limit, stop, stop limit, and market if touched, MIT. 1. The market order simply instructs your broker to buy or sell at the current market price. This is usually preferable in fast market conditions or when the trader wants to ensure that a position is taken and to protect against missing a potentially dynamic market move. 2. The limit order specifies a price that the trader is willing to pay or accept. A buy limit order is placed below the current market price and states the highest price the trader is willing to pay for a purchase. A sell limit order is placed over the current market price and is the lowest price the seller is willing to accept. This type of resting order is used, for example, after a bullish breakout when the buyer wants to buy a downside reaction closer to support. 3. A stop order can be used to establish a new position, limit a loss on an existing position, or protect a profit. A stop order specifies a price at which an order is to be executed. A buy stop is placed over the market and a sell stop under the market, which is the opposite of the limit order. Once the stop price is hit, the order becomes a market order and is executed at the best price possible. On a long position, a sell stop is placed below the market to limit a loss. After the market moves higher, the stop can be raised to protect the profit, a trailing stop. A buy stop could be placed above resistance to initiate a long position on a bullish breakout. Since the stop order becomes a market order, the actual fill price may be beyond the stop price, especially in a fast market. 4. A stop limit order combines both a stop and a limit order. This type of order specifies both a stop price, where the trade is activated, and a limit price. Once the stop is elected, the order becomes a limit order. This type of order is useful when the trader wants to buy or sell a breakout, but wants to control the price paid or received. 5. The market if touched MIT order is similar to a limit order, except that it becomes a market order when the limit price is touched. An MIT order to buy would be placed under the market like a limit order. When the limit price is hit, the trade is made at the market. This type of trade has one major advantage over the limit order. The buy limit order placed under the market does not guarantee a fill even if the limit price is touched. Prices may bounce sharply from the limit price, leaving the order unfilled. An MIT order is most useful when the trader wants to buy the dip, but doesn't want to risk missing the market after the limit price is hit. Here's the exact text you requested. Each of these orders is appropriate at certain times. Each has its own strong and weak points. Market orders guarantee a position, but may result in chasing the market. Limit orders provide more control and better prices, but risk missing the market. Stop limit orders also risk missing the market if prices gap beyond the limit price. Stop prices are strongly recommended to limit losses and protect profits. However, the use of a buy or sell stop to initiate new positions may result in bad fills. The market if touched order is particularly useful, but is not allowed on some exchanges. Familiarize yourself with the different types of orders and learn their strengths and weaknesses. Each of them has a place in your trading plan. Be sure to find out which types of orders are permitted on the various financial exchanges, from daily charts to intraday price charts. Because timing deals with very short-term market action, intraday price charts are especially useful. Intraday charts are indispensable for day trading purposes. Although that's not our focus here. We're mainly interested in how intraday activity can be used to aid the trader in the timing of purchases and sales once the basic decision to enter or exit a market has been made. It bears repeating that the trading process must begin with a long-range view and then gradually work toward the shorter term. Analysis begins with monthly and weekly charts for long-term perspective. Then the daily chart is consulted, which is the basis for the actual trading decision. The intraday chart is the last one viewed for even greater precision. The long-term chart gives a telescopic view of a market. The intraday chart allows more microscopic study. The technical principles already discussed are clearly visible on these very sensitive charts. See figures 16.1 to 16.3. The use of intraday pivot points. In order to achieve earlier entry with even tighter protective stops, some traders try to anticipate where a market will close by the use of pivot points. This technique combines 7 key price levels with 4 time periods. The 7 pivot points are the previous day's high, low, and close, and the current day's open, high, low, and close. The 4 time periods are applied to the current trading day. They are the open, 30 minutes after the open, midday. about 12:30 New York time, and 35 minutes before the close. These are average times and can be adjusted to the individual markets. The idea is to use pivot points only as a timing device when the trader believes a market is topping or bottoming. Buy or sell signals are given as the pivot points are broken during the day. The later in the day the signal is given, the stronger it is. As an illustration of a buy signal, if the market opens above the previous day's close, but is below the previous day's high, a buy stop is placed above the previous day's high. If the buy stop is elected, a protective sell stop is placed below the current day's low. At 35 minutes before the close, if no position has been taken, a buy stop is placed above the current day's high, with a protective stop under today's open. No action is generally taken during the first 30 minutes of trading. As the day progresses, the pivot points are narrowed, as are the protective stops. As a final requirement on a buy signal, prices must close above both the previous day's closing price and today's opening price. Summary of money management and trading guidelines. The following list pulls together most of the more important elements of money management and trading. 1. Trade in the direction of the intermediate trend. 2. In uptrends, buy the dips. In downtrends, sell bounces. 3. Let profits run, cut losses short. 4. Use protective stops to limit losses. 5. Don't trade impulsively. Have a plan. 6. Plan your work and work your plan. 7. Use money management principles. 8. Diversify, but don't overdo it. 9. Employ at least a 3-to-1 reward to risk ratio. 10. When pyramiding, adding positions, follow these guidelines. A. Each successive layer should be smaller than before. B. Add only to winning positions. C. Never add to a losing position. D. Adjust protective stops to the break-even point. 11. Never meet a margin call. Don't throw good money after bad. 12. Close out losing positions before the winning ones. 13. Except for very short-term trading, make decisions away from the market, preferably when the markets are closed. 14. Work from the long term to the short term. 15. Use intraday charts to fine-tune entry and exit. 16. Master intraday trading before trying intraday trading. 17. Try to ignore conventional wisdom. Don't take anything said in the financial media too seriously. 18. Learn to be comfortable being in the minority. If you're right on the market, most people will disagree with you. 19. Technical analysis is a skill that improves with experience and study. Always be a student and keep learning. 20. Keep it simple. More complicated isn't always better. Application to stocks. The trading tactics that we've covered in this chapter and the analytical tools in preceding chapters also apply to the stock market, with some minor adjustments. While futures traders focus on short to intermediate trends, stock investors are more concerned with intermediate to longer-term trends. Stock trading places less emphasis on the very short term and makes less use of intraday charts, but the general principles remain the same for analyzing and trading markets, whether they're in the futures pits of Chicago or on the floor of the New York Stock Exchange. Asset allocation. The money management guidelines presented in this chapter refer mainly to futures trading. However, many of the principles included in that discussion relate to the need for proper diversification in one's investment portfolio and touch on the subject of asset allocation. Asset allocation refers to how a person's portfolio is divided among stocks, bonds, and cash, usually in the form of a money market fund or treasury bills. It can also refer to how much of one's portfolio should be allocated to foreign markets. Asset allocation also refers to how one's stock holdings are spread among the various market sectors and industry groups. And, more recently, it deals with how much of one's portfolio should be allocated to traditional commodity markets. Managed accounts and mutual funds. Managed accounts have been available in the futures markets for several years and have provided a vehicle for those wishing to put some money into futures but lacked the expertise to do so themselves. Managed accounts have provided a sort of mutual fund approach to futures. Even though managed futures accounts invest in all futures markets, including currencies, commodities, bonds, and stock index futures, they still provide some measure of diversification from bonds and stocks. Part of the diversification is due to their practice of trading from both the long and the short side. Another part comes from the commodity portion itself. However, the ability to devote some of one's assets to commodities was made even easier during 1997. Oppenheimer Real Assets, launched in March 1997, is the first mutual fund devoted exclusively to commodity investing. By investing in commodity-linked notes, the fund is able to fashion a commodity portfolio that tracks the Goldman Sachs Commodity Index, which includes 22 commodity markets. Since commodities often trend in opposite directions to bonds and stocks, they provide an excellent diversification vehicle. Proper diversification requires spreading one's assets among market groups or classes that have a low correlation to each other. In other words, they don't always trend in the same direction. Commodities certainly fit that criteria. We point these things out for two reasons. One is to show that the areas of money management and asset allocation are very much intertwined. The second is to show that the markets themselves are very much intertwined. In the next two chapters, you'll see how closely linked the futures and stock markets really are, and why it's important that stock investors keep informed of what's going on in the futures markets. Chapter 17 will introduce you to intermarket technical analysis. Market profile. We couldn't leave the subject of intraday charts without introducing one of the most innovative approaches to intraday trading called market profile. This trading technique was developed by J. Peter Steidelmayer, a former floor trader on the Chicago Board of Trade. Mr. Steidelmayer's approach has gained an enthusiastic following over the past decade, especially in the futures markets. Market profile can, however, be applied to common stocks as well. It's not an easy approach to grasp, but those traders that have done so give it very high marks. Dennis Hines, an expert in market profile trading, explains the approach in Appendix B. End of Chapter 16. Chapter 17, the link between stocks and futures, intermarket analysis. When the first edition of this book was published in 1986, the separation of the commodity futures world from the more traditional world of stocks and bonds was already starting to break down. 20 years ago, commodities referred to such things as corn, soybeans, pork bellies, gold, and oil. These were traditional commodities that could be grown, mined, or refined. Dramatic changes took place from 1972 to 1982 with the introduction of futures contracts on currencies, treasury bonds, and stock index futures. The term commodities gave way to futures since bonds and stocks were hardly commodities, but they were futures contracts. Since then, the world of futures trading has blended with that of traditional stocks and bonds to the point that they can hardly be separated. As a result, the technical analysis methods used to analyze the different financial markets have become more universally applied. On any given day, quotes are readily available for dollar futures, bond futures, and stock index futures, and they often move in sync with one another. The direction those three markets move is often affected by what happens in the commodity pits. Program trading, which occurs when the price of the S&P 500 futures contract is out of line with the S&P 500 cash index, is a day-to-day reality. For those reasons, it seems clear that the more understanding you have about the world of futures trading, the more insight you will gain into the entire financial marketplace. It has become clear that action in the futures markets can have an important influence on the stock market itself. Early warning signs of inflation and interest rate trends are usually spotted in the futures pits first, which often determine the direction stock prices will take at any given time. Trends in the dollar tell us a lot about the strength or weakness of the American economy, which also has a major impact on corporate earnings and the valuation of stock prices. But the linkage goes even deeper than that. The stock market is divided into sectors and industry groups. Rotation into and out of those groups is often dictated by action in futures. With the tremendous growth in mutual funds, and sector funds in particular, the ability to capitalize on sector rotation into winning groups and out of losing ones become much simpler. In this chapter, we'll deal with the broader subject of intermarket analysis as it deals with the interplay between currencies, commodities, bonds, and stocks. Our primary message is how closely the four markets are linked. We'll show how to use the futures markets in the process of sector and industry group rotation within the stock market itself. Intermarket analysis. In 1991, I wrote a book entitled Intermarket Technical Analysis. That book described the interrelationships between the various financial markets, which are universally accepted today. The book provided a guide or blueprint to help explain the sequence that develops among the various markets and to show how interdependent they really are. The basic premise of intermarket analysis is that all financial markets are linked in some way. That includes international markets as well as domestic ones. Those relationships may shift on occasion, but they are always present in one form or another. As a result, a complete understanding of what's going on in one market, such as the stock market, isn't possible without some understanding of what's going on in other markets. Because the markets are now so intertwined, the technical analyst has an enormous advantage. The technical tools described in this book can be applied to all markets, which greatly facilitates the application of intermarket analysis. You'll also see why the ability to follow the charts of so many markets is a tremendous advantage in today's complex marketplace. Program trading, the ultimate link. Nowhere is the close link between stocks and futures more obvious than in the relationship between the S&P 500 cash index and the S&P 500 futures contract. Normally, the futures contract trades at a premium to the cash index. The size of that premium is determined by such things as the level of short-term interest rates, the yield on the S&P 500 index itself, and the number of days until the futures contract expires. The premium, or spread, between S&P 500 futures over the cash index diminishes as the futures contract approaches expiration. See Figure 17.1. Each day, institutions calculate what the actual premium should be, called fair value. That fair value remains constant throughout the trading day, but changes gradually with each new day. When the futures premium moves above its fair value to the cash index by some predetermined amount, an arbitrage trade is automatically activated, called program buying. When the futures are too high relative to the cash index, program traders sell the futures contract and buy a basket of stocks in the S&P 500 to bring the two entities back into line. The result of program buying is positive for the stock market since it pushes the S&P 500 cash index higher. Program selling is just the opposite and occurs when the premium of the futures over the cash narrows too far below its fair value. In that case, program selling is activated, which results in the buying of S&P 500 futures and selling of the basket of stocks. Program selling is negative for the market. Most traders understand this relationship between the two related markets. What they don't always understand is that the sudden moves in the S&P 500 futures contract, which activate the program trading, are often caused by sudden moves in other futures markets, like bonds. The link between bonds and stocks. The stock market is influenced by the direction of interest rates. The direction of interest rates, or yield, can be monitored on a minute-to-minute basis by tracking the movements in the Treasury bond futures contract. Bond prices move in the opposite direction of interest rates or yields. Therefore, when bond prices are rising, yields are falling. That is normally considered positive for stocks. Falling bond prices, or rising yields, are considered negative for stocks. From a technician's point of view, it is very easy to compare the charts of Treasury bond futures with the charts of either the S&P 500 cash index or its related futures contract. You'll see that they have generally trended in the same direction. See Figure 17.2. On a short-term basis, sudden changes in trend in the S&P 500 futures contract are often influenced by sudden changes in the Treasury bond futures contract. On a longer-range basis, changes in the trend of the Treasury bond contract often warn of similar turns in the S&P 500 cash index itself. In that sense, bond futures can be viewed as a leading indicator for the stock market. Bond futures, in turn, are usually influenced by trends in the commodity markets. The link between bonds and commodities. Treasury bond prices are influenced by expectations for inflation. Commodity prices are considered to be leading indicators of inflationary trends. As a result, commodity prices usually trend in the opposite direction of bond prices. If you study the market's history since the 1970s, you'll see that sudden upturns in commodity markets, signaling higher price inflation, have usually been associated with corresponding declines in Treasury bond prices. The flip side of that relationship is that strong Treasury bond gains have normally corresponded with falling commodity prices. See Figure 17.3. Commodity prices, in turn, are impacted by the direction of the U.S. dollar. The link between commodities and the dollar. A rising U.S. dollar normally has a depressing effect on most commodity prices. In other words, a rising dollar is normally considered to be non-inflationary. See Figure 17.4. One of the commodities most affected by the dollar is the gold market. If you study their relationship over time, you'll see that the prices of gold and the U.S. dollar usually trend in opposite directions. See Figure 7.5. The gold market, in turn, usually acts as a leading indicator for other commodity markets. So, if you're analyzing the gold market, it's necessary to know what the dollar is doing. If you're studying the commodity price trend in general, using one of the better-known commodity price indexes, it's necessary to know what the gold market is doing. The fact of the matter is that all four markets are linked. The dollar influences commodities, which influence bonds, which influence stocks. To fully comprehend what's happening in any one asset class, it's necessary to know what's happening in the other three. Fortunately, that's easily done by simply looking at their respective price charts, stock sectors, and industry groups. An understanding of these intermarket relationships also sheds light on the interaction between the various stock market sectors and industry groups. The stock market is divided into market sectors, which are then subdivided into industry groups. These market categories are influenced by what's happening on the intermarket scene. For example, when bonds are strong and commodities weak, interest rate-sensitive stock groups, such as the utilities, financial stocks, and consumer staples usually do well relative to the rest of the stock market. At the same time, inflation-sensitive stock groups like gold, energy, and cyclical stocks usually underperform. When commodity markets are strong relative to bonds, the opposite is the case. By monitoring the relationship between treasury bond prices and commodity prices, you can determine which sectors or industry groups will do better at any given time. Since there is such a close relationship between stock market sectors and their related futures markets, they can be used in conjunction with each other. Utility stocks, for example, are closely linked to treasury bond prices. See Figure 17.6. Gold mining shares are closely linked to the price of gold. What's more, the related stock groups often tend to lead their respective futures markets. As a result, utility stocks can be used as leading indicators for treasury bonds. Gold mining shares can be used as leading indicators for gold prices. Another example of intermarket influence is the impact of the trend of oil prices on energy and airline stocks. Rising oil prices help energy shares but hurt airlines. Falling oil prices have the opposite effect: the dollar and large caps. Another intermarket relationship involves how the dollar affects large and small cap stocks. Large multinational stocks can be negatively impacted by a very strong dollar, which may make their products too expensive in foreign markets. By contrast, the more domestically oriented small cap stocks are less affected by dollar movements and may actually do better than larger stocks in a strong dollar environment. As a result, a stronger dollar may favor smaller stocks, like those in the Russell 2000, while a weaker dollar may benefit the large multinationals, like those in the Dow Industrial Average. Intermarket analysis and mutual funds. It should be obvious that some understanding of these intermarket relationships can go a long way in mutual fund investing. The direction of the US dollar, for example, might influence your commitment to small cap funds versus large cap funds. It may also help determine how much money you might want to commit to gold or natural resource funds. The availability of so many sector-oriented mutual funds actually complicates the decision of which ones to emphasize at any given time. That task is made a good deal easier by comparing the relative performance of the futures markets and the various stock market sectors and industry groups. That is easily accomplished by a simple charting approach called relative strength analysis. Relative strength analysis. This is an extremely simple but effective charting tool. All you do is divide one market entity by another. In other words, plot a ratio of two market prices. When the ratio line is rising, the numerator price is stronger than the denominator. When the ratio line is declining, the denominator market is stronger. Consider some examples of what you can do with this simple indicator. Divide a commodity index, such as the CRB Futures Price Index, by Treasury bond futures prices. See Figure 17.7. When the ratio line is rising, commodity prices are outperforming bonds. In that scenario, futures traders would be buying commodity markets and selling bonds. At the same time, stock traders would be buying inflation-sensitive stocks and selling interest rate-sensitive stocks. When the ratio line is falling, they would be doing the opposite. That is, they would sell commodities and buy bonds. At the same time, stock investors would be selling the golds, the oils, and the cyclicals, while buying the utilities, the financials, and consumer staples. See Figure 17.8. Relative strength in sectors. Many exchanges now trade index options on various stock market sectors. The Chicago Board Options Exchange has the greatest selection and includes such diverse groups as automotive, computer software, environmental, gaming, real estate, healthcare, retail, and transportation. The American and Philadelphia Stock Exchanges offer popular index options on banks, gold, oil, pharmaceuticals, semiconductors, technology, and utilities. All of these index options can be charted and analyzed like any other market. The best way to use relative strength analysis on them is to divide their price by some industry benchmark, such as the S&P 500. You can then determine which are outperforming the overall market, a rising RS line, or underperforming, a falling RS line. Employing some simple charting tools like trend lines and moving averages on the relative strength lines themselves will help you spot important changes in their trend. See Figure 17.9. The general idea is to rotate your funds into those sectors of the market whose relative strength lines are just turning up, and to rotate out of those market groups whose relative strength lines are just turning down. Those moves can be implemented either with the index options themselves or through mutual funds that match the various market sectors and industry groups. Relative strength and individual stocks. Investors have two ways to go at that point. They can simply rotate their funds out of one market group into another and stop there. Or, if they wish, they can continue on to choose individual stocks within those groups. Relative strength analysis plays a role here as well. Once the desired index has been chosen, the next step is to divide each of the individual stocks within the index by the index itself. In that way, you can easily spot the individual stocks that are showing the greatest relative strength. See Figure 17.10. You can purchase the stocks showing the strongest ratio lines, or you can buy a cheaper stock whose ratio line may just be turning up. The idea, however, is to avoid stocks whose relative strength ratio lines are still falling. Top-down market approach. What we've described here is a top-down market approach. You begin by studying the major market averages to determine the trend of the overall market. Then you select those market sectors or industry groups that are showing the best relative strength. Then you select individual stocks within those groups that are also showing the best relative strength. By incorporating intermarket principles into your decision-making process, you can also determine whether the current market climate favors bonds, commodities, or stocks, which can play a role in your asset allocation decisions. The same principles can also be applied to international investing by simply comparing the relative strength of the various global stock markets. And finally, all of these technical tools described herein can be applied to charts of mutual funds as a final check on your analysis. All of this work is easily done with price charts and a computer. Imagine trying to apply fundamental analysis to so many markets at the same time. Deflation scenario. The intermarket principles described herein are based on market trends since 1970. The 1970s saw runaway inflation, which favored commodity assets. The decades of the 1980s and 1990s have been characterized by falling commodities, disinflation, and strong bull markets in bonds and stocks. During the second half of 1997, a severe downturn in Asian currency and stock markets was especially damaging to markets like copper, gold, and oil. For the first time in decades, some market observers expressed concern that a beneficial disinflation, prices rising at a slower level, might turn into a harmful deflation, falling prices. To add to the concerns, producer prices fell on an annual basis for the first time in more than a decade. As a result, the bond and stock markets began to decouple. For the first time in 4 years, investors were switching out of stocks and putting more money into bonds and rate-sensitive stock groups like utilities. The reason for that asset allocation adjustment is that deflation changes the intermarket scenario. The inverse relationship between bond prices and commodities is maintained. Commodities fall while bond prices rise. The difference is that the stock market can react negatively in that environment. We point this out because it's been a long time since the financial markets had to deal with the problem of price deflation. If and when deflation does occur, intermarket relationships will still be present, but in a different way. Disinflation is bad for commodities, but good for bonds and stocks. Deflation is good for bonds and bad for commodities, but may also be bad for stocks. The deflationary trend that started in Asia in mid-1997 spread to Russia and Latin America by mid-1998 and began to hurt all global equity markets. A plunge in commodity prices had an especially damaging impact on commodity exporters like Australia, Canada, Mexico, and Russia. The deflationary impact of falling commodity and stock prices had a positive impact on Treasury bond prices, which hit record highs. Market events of 1998 were a dramatic example of the existence of global intermarket linkages and demonstrated how bonds and stocks can decouple in a deflationary world. Intermarket correlation. Two markets that normally trend in the same direction, such as bonds and stocks, are positively correlated. Markets that trend in opposite directions, like bonds and commodities, are negatively correlated. Charting software allows you to measure the degree of correlation between different markets. A high positive reading suggests a strong positive correlation. A high negative reading suggests a strong negative correlation. A reading near zero suggests little or no correlation between two markets. By measuring the degree of correlation, the trader is able to establish how much emphasis to place on a particular intermarket relationship. More weight should be placed on those with higher correlations, and less weight on those closer to zero. See Figure 17.11. In his book, Cybernetic Trading Strategies, Murray Ruggiero Jr. presents creative work on the subject of intermarket correlations. He also shows how to use intermarket filters on trading systems. He demonstrates, for example, how a moving average crossover system in the bond market can be used as a filter for stock index trading. Ruggiero explores the application of state-of-the-art artificial intelligence methods like chaos theory, fuzzy logic, and neural networks to the development of technical trading systems. He also explores the application of neural networks to the field of intermarket analysis. Intermarket neural network software. One major problem with the study of intermarket relationships is that there are so many of them, and they're all interacting at the same time. That's where neural networks come into play. Neural networks provide a more quantitative framework for identifying and tracking the complex relationships that exist among the financial markets. Louis Mendelssohn, president of Market Technologies Corporation, 25941 Apple Blossom Lane, Wesley Chapel, FL 33544, email address 45141@profittaker.com, website URL .profittaker.com/45141, was the first person to develop intermarket analysis software in the financial industry during the 1980s. Mendelssohn is the leading pioneer in the application of microcomputer software and neural networks to intermarket analysis. His Vantage Point software, first introduced in 1991, uses intermarket principles to trade interest rate markets, stock indexes, currency markets, and energy futures. Vantage Point uses neural network technology to detect the hidden patterns and correlations that exist between related markets. Conclusion. This chapter summarizes the main points included in my book, Intermarket Technical Analysis. It discusses the ripple effect that flows from the dollar to commodities to bonds to stocks. Intermarket work also recognizes the existence of global linkages. What happens in Asia, Europe, and Latin America has an impact on U.S. markets and vice versa. Intermarket analysis sheds light on sector rotation within the stock market. Relative strength analysis is helpful for seeking out asset classes, market sectors, or individual stocks that are likely to outperform the general market. In his book, Leading Indicators for the 1990s, Dr. Jeffrey Moore shows how the interaction between commodity prices, bond prices, and stock prices follows a sequential pattern that tracks the business cycle. Dr. Moore substantiates the intermarket rotation within the three asset classes and argues for their use in economic forecasting. In doing so, Dr. Moore elevates intermarket work and technical analysis in general into the realm of economic forecasting. Finally, technical analysis can be applied to mutual funds like any other market, with some minor modifications. That being the case, all of the techniques discussed in this book can be applied right on the mutual fund charts themselves. Even better, the lower degree of volatility in mutual fund charts makes them excellent vehicles for chart analysis. My latest book, The Visual Investor, deals more extensively with the subject of sector analysis and trading and shows how mutual funds can be charted and then used to implement various trading strategies. See Figure 17.12. End of Chapter 17. Chapter 18, Stock Market Indicators. Measuring Market Breadth. In the previous chapter, we described the top-down approach that is most commonly employed in stock market analysis. With that approach, you begin your analysis with a study of the health of the overall market. Then you work down to market sectors and industry groups. The final step is the study of individual stocks. Your goal is to pick the best stocks in the best groups in an environment when the stock market is technically healthy. The study of market sectors and individual stocks can be accomplished with the technical tools employed throughout this book, including chart patterns, volume analysis, trend lines, moving averages, oscillators, etc. Those same indicators can also be applied to the major market averages. But there's another class of market indicators widely employed in stock market analysis whose purpose is to determine the health of the overall stock market by measuring market breadth. The data used in their construction are advancing versus declining issues, new highs versus new lows, and up volume versus down volume. Sample data. If you check the Stock Market Data Bank section of the Wall Street Journal, Section C, page 2, each day, you'll find the following data for the previous trading day. The numbers shown are based on an actual day's trading results. The above figures are derived from New York Stock Exchange YSE data. A similar breakdown is also shown for the NASDAQ and the American Stock Exchange. We'll concentrate on the NYSE in this discussion. It just so happens that on that particular day, the Dow Jones Industrial Average had gained 12.20 points. So the market was up as measured by the Dow. However, there were more declining stocks, 1,559, than advancing stocks, 1,327, suggesting that the broader market didn't fare as well as the Dow. There was also more declining volume than advancing volume. Those two sets of figures suggest that market breadth was actually negative for that particular day, even though the Dow itself closed higher. The other figures present a more mixed picture. The number of stocks hitting new 52-week highs, 78, was greater than those hitting new lows, 43, suggesting a positive market environment. However, the closing tick, the number of stocks that caught an uptick versus a downtick, was a negative, minus 135. That meant that 135 more stocks closed on a downtick than an uptick, a short-term negative factor. The negative closing tick, however, is offset by a closing arms TRIN reading of 9.6, which is mildly positive. We'll explain why that is later in the chapter. All of these internal market readings have one intended purpose: to give us a more accurate reading on the health of the overall market that isn't always reflected in the movement of the Dow itself. Comparing market averages. Another way to study the breadth of the market is to compare the performance of the stock averages themselves. Using the same day's trading as an example, the following data lists the relative performance of the major stock averages. Dow Industrials 12.20 +0.16%, S&P 500 0.64 -0.7%, Nasdaq Composite 14.47992%, Russell 2000 3.80 -0.89. The first thing that is clear is that the Dow Industrials was the only market average to gain on the day. On all the TV news programs that night, investors were told that the market represented by the Dow was up for the day, yet all the other measures were actually down. Notice also that the broader the average, the more stocks included, the worse it did. Compare the percentage changes. The 30-stock Dow gained 0.16%. The S&P 500 lost 0.07%. The Nasdaq Composite, which includes more than 5,000 stocks, was the day's worst performer and lost 0.92%. Almost as bad as the Nasdaq was the Russell 2000, -0.89%, which is a measure of 2,000 small-cap stocks. The message in this brief comparison is that even though the Dow gained on the day, the overall market lost ground as measured by the more broader-based stock averages. We'll revisit the idea of comparing market averages again. But first, let's show the different ways market technicians can analyze the market's breadth numbers. The advanced decline line. This is the best known of the breadth indicators. The construction of the advanced decline line is extremely simple. Each day's trading on the New York Stock Exchange produces a certain number of stocks that advanced, a number that declined, and a number that remained unchanged. These figures are reported each day in the Wall Street Journal and Investor's Business Daily and are used to construct a daily advanced decline AD line. The most common way to calculate the AD line is to take the difference between the number of advancing issues and the number of declining issues. If there are more advances than declines, the AD number for that day is positive. If there are more declines than advances, the AD line for that day is negative. That positive or negative daily number is then added to the cumulative AD line. The AD line displays a trend of its own. The idea is to make sure the AD line and the market averages are trending in the same direction. See Figure 18.1. AD divergence. What does the advanced decline line measure? The advanced decline line tells us whether or not the broader universe of 3,500 NYSE stocks is advancing in line with the most widely followed stock averages, which include only the 30 Dow Industrials or the 500 stocks in the S&P 500. To paraphrase a Wall Street maxim, the advanced decline line tells us if the troops are keeping up with the generals. As long as the AD line is advancing with the Dow Industrials, for example, the breadth or health of the market is good. The danger appears when the AD line begins to diverge from the Dow. In other words, when you have a situation where the Dow Industrials are hitting new highs while the broader market, measured by the AD line, isn't following, technicians begin to worry about bad market breadth or an AD divergence. Historically, the AD line peaks out well ahead of the market averages, which is why it's watched so closely. Daily versus weekly ad lines. The daily AD line, which we have described herein, is better used for short to intermediate comparisons with the major stock averages. It is less useful for comparisons going back several years. A weekly advanced decline line measures the number of advancing versus declining stocks for the entire week. Those figures are published in Barron's each weekend. A weekly advanced decline line is considered more useful for trend comparisons spanning several years. While a negative divergence in the daily AD line may warn of short to intermediate problems in the market, it's necessary to also show a similar divergence in the weekly AD line to confirm that a more serious problem is developing. Variations in AD line. Since the number of stocks traded on the NYSE has grown over the years, some market analysts believe the method of subtracting the number of declining issues from the number of advancing issues gives greater weight to the more recent data. To combat that problem, many technicians prefer to use an advanced decline ratio, which divides the number of advancing issues by the number of declining issues. Some also believe that there's value in including the number of unchanged issues in the calculation. Whichever way the AD line is calculated, its use is always the same. That is, to measure the direction of the broader market and to ensure it's moving in the same direction as the more narrowly constructed but popular market averages. Advanced decline lines can also be constructed for the American Stock Exchange and the NASDAQ market. Market technicians like to construct overbought, oversold oscillators on the AD lines to help measure short to intermediate term market extremes in the breadth figures themselves. One of the better-known examples is the McClellan oscillator. McClellan oscillator. Developed by Sherman McClellan, this oscillator is constructed by taking the difference between two exponential moving averages of the daily NYSE advanced decline figures. The McClellan oscillator is the difference between the 19-day 10% trend and the 39-day 5% trend exponential moving averages of the daily net advanced decline figures. The oscillator fluctuates around a zero line with its upper and lower extremes ranging from plus 100 and minus 100. A McClellan oscillator reading above plus 100 is a signal of an overbought stock market. A reading below minus 100 is considered an oversold stock market. Crossings above and below the zero line are also interpreted as short to intermediate term buying and selling signals respectively. See Figure 18.2. McClellan Summation Index. The Summation Index is simply a longer-range version of the McClellan oscillator. The McClellan Summation Index is a cumulative sum of each day's positive or negative readings in the McClellan oscillator. Whereas the McClellan oscillator is used for short to intermediate trading purposes, the Summation Index provides a longer-range view of market breadth and is used to spot major market turning points. See Figure 18.3, New Highs versus New Lows. In addition to the number of advancing and declining stocks, the financial press also publishes the number of stocks hitting new 52-week highs or new 52-week lows. Here again, these figures are available on a daily and weekly basis. There are two ways to show these figures. One way is to plot the two lines separately, since the daily values can sometimes be erratic. Moving averages, usually 10 days, are plotted to present a smoother picture of the two lines. See Figure 18.4. In a strong market, the number of new highs should be much greater than the number of new lows. When the number of new highs start to decline or the number of new lows start to expand, a caution signal is given. A negative market signal is activated when the moving average of new lows crosses above the moving average of new highs. It can also be shown that whenever the new highs reach an extreme, the market has a topping tendency. Similarly, whenever new lows reach an extreme, the market is near a bottom. Another way to use the new highs versus new lows numbers is to plot the difference between the two lines. New high, new low index. The advantage of a new high, new low index is that it can be directly compared to one of the major market averages. In that way, the high-low line can be used just like an advanced decline line. See Figure 18.5. The trend of the high-low line can be charted and it can be used to spot market divergences. A new high in the Dow, for example, that is not matched by a corresponding new high in the high-low line could be a sign of weakness in the broader market. Trendline and moving average analysis can be applied to the line itself, but its major value is in either confirming or diverging from the major stock trends and giving early warning of potential trend changes in the overall market. Dr. Alexander Elder describes the new high, new low index as probably the best leading indicator of the stock market. Trading for a living, Wiley. Elder suggests plotting the indicator as a histogram with a horizontal reference point at its zero line, making divergences easier to spot. He points out that crossings above and below the zero line also reflect bullish and bearish shifts in market psychology. Upside versus downside volume. This is the third and final piece of data that is utilized to measure the breadth of the market. The New York Stock Exchange also provides the level of volume in both the advancing and declining issues. That data is also available the next day in the financial press. It is then possible to compare the upside volume versus the downside volume to measure which is dominant at any given time. See Figure 18.6. The upside volume and downside volume can be shown as two separate lines, just as we did with the new highs and new lows figures. Or the difference can be shown as a single line. Either way, the interpretation is always the same. When the upside volume is dominant, the market is strong. When downside volume is greater, the market is weak. It's possible to combine the number of advancing and declining issues with advancing and declining volume. That's what Richard Arms did in the creation of the Arms Index. The Arms Index, The ARMS index, named after its creator Richard Arms, is a ratio of a ratio. The numerator is the ratio of the number of advancing issues divided by the number of declining issues. The denominator is the advancing volume divided by declining volume. The purpose of the ARMS index is to gauge whether there's more volume in rising or falling stocks. A reading below 1.0 indicates more volume in rising stocks and is positive. A reading above 1.0 reflects more volume in declining issues and is negative. On an intraday basis, a very high ARMS index reading is positive, while a very low reading is negative. The ARMS index, therefore, is a contrary indicator that trends in the opposite direction of the market. It can be used for intraday trading by tracking its direction and for spotting signs of short-term market extremes. See Figure 18.7. TRIN versus TIck. The ARMS index, TRIN, can be used in conjunction with the tick indicator for intraday trading. Tick measures the difference between the number of stocks trading on an uptick versus the number trading on a downtick. The tick is a minute-by-minute version of the daily advanced decline line and is used for the same purpose. When combining the two during the day, a rising tick indicator and a falling ARMS index, TRIN, are positive, while a falling tick indicator and a rising ARMS index, TRIN, are negative. The ARMS index, however, can also be used for longer range analysis. Smoothing the ARMS index. While the ARMS index is quoted throughout the trading day and has some short-term forecasting value, most traders use a 10-day moving average of its values. According to Arms himself, a 10-day average of the ARMS index above 1.20 is considered oversold, while a 10-day ARMS value below 0.70 is overbought, although those numbers may shift depending on the overall trend of the market. Arms expresses a preference for Fibonacci numbers as well. He suggests using a 21-day ARMS index in addition to the 10-day version. He also utilizes 21-day and 55-day moving average crossovers of the ARMS index to generate good intermediate-term trades. For more in-depth treatment, read the ARMS Index Trit by Richard W. Arms, Jr. Open ARMS. In calculating the 10-day ARMS index, each day's closing value is determined using the 4 inputs, and that final value is smoothed with a 10-day moving average. In the open version of the ARMS index, each of the 4 components in the formula is averaged separately over a period of 10 days. The open ARMS index is then calculated from those 4 different averages. Many analysts prefer the open ARMS version to the original version. Different moving average lengths, like 21 and 55 days, can also be applied to the open ARMS version. See Figure 18.8. Equilibrium charting. Although Arms is best known for creating the ARMS index, he has also pioneered other ways of combining price and volume analysis. In doing so, he created an entirely new form of charting called equivolume. In the traditional bar chart, the day's trading range is shown on the price bar, with the volume bar plotted at the bottom of the chart. Since technical analysts combine price and volume analysis, they have to look at both parts of the chart at the same time. On the equivolume chart, each price bar is shown as a rectangle. The height of the rectangle measures the day's trading range. The width of the rectangle is determined by that day's volume. Heavier volume days produce a wider rectangle. Lighter volume days are reflected in a narrower rectangle. See Figure 18.9. As a rule, a bullish price breakout should always be accompanied by a burst of trading activity. On an equivolume chart, therefore, a bullish price breakout should be accompanied by a noticeably wider rectangle. Equivolume charting combines price and volume analysis into one chart and makes for much easier comparisons between price and volume. In an uptrend, for example, up days should see wider rectangles, while down days should see narrower rectangles. Equivolume charting can be applied to market averages as well as individual stocks and can be plotted for both daily and weekly charts. For more information, consult Volume Cycles in the Stock Market by Richard Arms, Dow Jones Irwin, 1983. Candle Power. In Chapter 12, Greg Morris explained candlestick charting. In a 1990 article published in Technical Analysis of Stocks and Commodities magazine, entitled East Meets West, Candle Power Charting, Morris proposed combining candlestick charts with Arms' equivolume charting method. Morris's version shows the candlestick chart in an equivolume format. In other words, the width of the candlestick is determined by the volume. The greater the volume, the wider the candlestick. Morris called the combination candle power charting. Quoting from the article, the candle power chart offers similar, if not better, information than equilibrium or candlestick charting and is as visually appealing as either of them. Morris's candle power technique is available on Metastock charting software, published by Aquis International, 3950S 700 East, Suite 100, Salt Lake City, UT 84107. 800-882-3040, wwequus.com. However, its name has been changed to candle volume. See Figure 18.110. Comparing market averages. At the start of the chapter, we mentioned that another way to gauge market breadth was to compare the different market averages themselves. We're talking here primarily about the Dow Industrials, the S&P 500, the New York Stock Exchange Index, the NASDAQ Composite, and the Russell 2000. Each measures a slightly different portion of the market. The Dow and the S&P 500 capture the trends of a relatively small number of large capitalization stocks. The NYSE Composite Index includes all stocks traded on the New York Stock Exchange and gives a slightly broader perspective. Breakouts in the Dow Industrials should, as a rule, be confirmed by similar breakouts in both the S&P 500 and the NYSE Composite Index if the breakout is to have staying power. Most important divergences involve the NASDAQ and the Russell 2000. The NASDAQ Composite has the largest number of stocks, 5,000. However, since the NASDAQ is a capitalization-weighted index, it is usually dominated by the 100 largest technology stocks like Intel and Microsoft. Because of that, the NASDAQ is more often a measure of the direction of the technology sector. The Russell 2000 is a truer measure of the smaller stock universe. Both indexes, however, should be trending upward along with the Dow and the S&P 500 if the trend of the market is truly healthy. Relative strength, RS analysis, plays a useful role here. A ratio of the NASDAQ to the S&P 500 tells us whether the technology stocks are leading or lagging. It's usually better for the market if they're leading, and the ratio line is rising. See Figure 18.11. A comparison of the Russell 2000 and the S&P 500 tells us whether the troops are following the generals. When the small stocks are showing poor relative strength or are lagging too far behind the large stocks, that's often a warning that market breadth is weakening. See Figure 18.12. Conclusion. Another example of comparing two market averages for signs of confirmation or divergence involves the Dow Theory. In Chapter 2, we discussed the importance of the relationship between the Dow Industrials and the Dow Transports. A Dow Theory buy signal is present when both averages hit new highs. When one diverges from the other, a caution signal is given. It can be seen then that the study of market breadth and the related issues of confirmation and divergence can take many forms. The general rule to follow is that the greater the number of stock market averages that are trending in the same direction, the greater the chances are for that trend continuing. In addition, be sure to check the advanced decline line, the new highs, new lows line, and the upside-downside volume lines to make sure that they're also trending in the same direction. End of Chapter 18. Chapter 19, Pulling It All Together, a checklist. As this book has demonstrated, technical analysis is a blend of many approaches. Each approach adds something to the analyst's knowledge of the market. Technical analysis is much like putting together a giant jigsaw puzzle. Each technical tool holds a piece of the puzzle. My approach to market analysis is to combine as many techniques as possible. Each works better in certain market situations. The key is knowing which tools to emphasize in the current situation. That comes with knowledge and experience. All of these approaches overlap to some extent and complement one another. The day the user sees these interrelationships and is able to view technical analysis as the sum of its parts is the day that person deserves the title of technical analyst. The following checklist is provided to help the user touch all the bases, at least in the early going. Later on, the checklist becomes second nature. The checklist is not all-inclusive, but does have most of the more important factors to keep in mind. Sound market analysis seldom consists of doing the obvious. The technician is constantly seeking clues to future market movement. The final clue that leans the trader in one direction or the other is often some minor factor that has gone largely unnoticed by others. The more factors the analyst considers, the better the chances of finding that right clue. Technical checklist. 1. What is the direction of the overall market? 2. What is the direction of the various market sectors? 3. What are the weekly and monthly charts showing? 4. Are the major, intermediate, and minor trends up, down, or sideways? 5. Where are the important support and resistance levels? 6. Where are the important trend lines or channels? 7. Are volume and open interest confirming the price action? 8. Where are the 33%, 50%, and 66% retracements? 9. Are there any price gaps, and what type are they? 10. Are there any major reversal patterns visible? 11. Are there any continuation patterns visible? 12. What are the price objectives from those patterns? 13. Which way are the moving averages pointing? 14. Are the oscillators overbought or oversold? 15. Are any divergences apparent on the oscillators? 16. Are contrary opinion numbers showing any extremes? 17. What is the Elliott wave pattern showing? 18. Are there any obvious 3 or 5 wave patterns? 19. What about Fibonacci retracements or projections? 20. Are there any cycle tops or bottoms due? 21. Is the market showing right or left translation? 22. Which way is the computer trend moving? Up, down, or sideways? 23. What are the point and figure charts or candlesticks showing? After you've arrived at a bullish or bearish conclusion, ask yourself the following questions. 1. Which way will this market trend over the next several months? 2. Am I going to buy or sell this market? 3. How many units will I trade? 4. How much am I prepared to risk if I'm wrong? 5. What is my profit objective? 6. Where will I enter the market? 7. What type of order will I use? 8. Where will I place my protective stop? Going through the checklist won't guarantee the right conclusions. It's only meant to help you ask the right questions. Asking the right questions is the surest way of finding the right answers. The keys to successful trading are knowledge, discipline, and patience. Assuming that you have the knowledge, the best way to achieve discipline and patience is doing your homework and having a plan of action. The final step is putting that plan of action to work. Even that won't guarantee success, but it will greatly increase the odds of winning in the financial markets. How to coordinate technical and fundamental analysis. Despite the fact that technicians and fundamentalists are often at odds with one another, there are ways they can work together for mutual benefit. Market analysis can be approached from either direction. While I believe that technical factors do lead the known fundamentals, I also believe that any important market move must be caused by underlying fundamental factors. Therefore, it simply makes sense for a technician to have some awareness of the fundamental condition of a market. If nothing else, the technician can inquire from his or her fundamental counterpart as to what would have to happen fundamentally to justify a significant market move identified on a price chart. In addition, seeing how the market reacts to fundamental news can be used as an excellent technical indication. The fundamental analyst can use technical factors to confirm an analysis or as an alert that something important may be happening. The fundamentalist can consult a price chart or use a computer trend following system as a filter to prevent him or her from assuming a position opposite an existing trend. Some unusual action on a price chart can act as an alert for the fundamental analyst and cause him or her to examine the fundamental situation a bit closer. During my years in the technical analysis department of a major brokerage firm, I often approached our fundamental department to discuss some market move that seemed imminent on the price charts. I often received responses like, "That can never happen," or "No way." Very often, that same person was scrambling a couple of weeks later to find fundamental reasons to explain a sudden and unexpected market move. There's obviously room for much more coordination and cooperation in this area. A lot of people use technical analysis and offer opinions on the technical condition of the various markets. But are they really qualified to do so? How would you know? After all, you wouldn't go to a doctor who didn't have a medical degree on the wall, nor would you consult a lawyer who hadn't passed the bar exam. Your accountant is undoubtedly a CTA. If you asked a security analyst for an assessment on a common stock, you would certainly make sure that he or she was a chartered financial analyst, CFA. Why wouldn't you take the same precautions with a technical analyst? The Market Technicians Association, MTA, resolved this question by instituting a Chartered Market Technician, CMT, program. The CMT program is a 3-step examination process that qualifies the analyst to carry the CMT letters after his or her name. Most professional technical analysts have gone through the program. The next time someone offers you his or her technical opinion, ask to see the CMT. Market Technicians Association, MTA. The Market Technicians Association, MTA, is the oldest and best-known technical society in the world. It was founded in 1972 to encourage the exchange of technical ideas. educate the public and the investment community, and establish a code of ethics and professional standards among technical analysts. On March 11, 1998, the MTA celebrated the 25th birthday of its incorporation. The event was highlighted by a special presentation at the New York monthly meeting by three of the organization's founding members, Ralph Acampora, John Brooks, and John Greeley. MTA membership includes full-time technical analysts and other interested parties, called affiliates. Monthly meetings are held in New York, Market Technicians Association, Inc., One World Trade Center, Suite 4447, New York, NY 148 212-912-0995. Email shelleymta@aol.com. And an annual seminar is held each May at various locations around the country. Members have access to the MTA library and a computer bulletin board. A monthly newsletter and a periodic MTA journal are published. Some regional chapters have even been formed. MTA members also become colleagues of the International Federation of Technical Analysts, IFTA. The global reach of technical analysis. During the fall of 1985, a meeting was held in Japan with technical representatives of several different countries to draft a constitution for the International Federation of Technical Analysts, IFTA, Post Office Box 1347, New York, 1009, USA. Since then, the organization has grown to include technical analysis organizations from more than 20 countries. One of the nice things about being a member is that annual meetings are held in places like Australia, Japan, Paris, and Rome, since a different national organization hosts each seminar. I'm proud to say that in 1992, I received the first award ever given at an IFTA conference for outstanding contribution to global technical analysis. Technical analysis by any name. After a century of use in this country and 300 years in Japan, technical analysis is more popular than ever. Of course, it's not always called technical analysis. In my book, The Visual Investor, I called it visual analysis. That was simply an attempt to get people beyond the intimidating title of technical analysis and to get them to examine this valuable approach more closely. Whatever you want to call it, technical analysis is practiced under many names. A lot of financial organizations employ analysts whose job it is to number crunch market prices to find stocks or stock groups that are expensive, overbought, or cheap, oversold. They're called quantitative analysts, but the numbers they crunch are often the same ones the technicians are crunching. The financial press has written about a new class of trader called momentum players. These traders move funds out of stocks and stock groups that are showing poor momentum and into those that are showing good momentum. They use a technique called relative strength. Of course, we recognize momentum and relative strength as technical terms. Then there are the brokerage firms' fundamental upgrades and downgrades. Have you noticed how often these fundamental changes take place the day after a significant chart breakout or breakdown? Economists, who certainly don't consider themselves technical analysts, use charts all the time to measure the direction of inflation, interest rates, and all sorts of economic indicators. And they talk about the trend of those charts. Even fundamental tools like the price-earnings ratio have a technical side to them. Anytime you introduce price into the equation, you're moving into the realm of technical analysis. Or when security analysts say the dividend yield of the stock market is too low, aren't they saying prices are too high? Isn't that the same thing as saying a market is overbought? Finally, there are the academics who have reinvented technical analysis under the new name of behavioral finance. For years, the academics espoused the efficient market hypothesis to prove that technical analysis simply didn't work. No less an authority than the Federal Reserve Board has thrown some doubt on those ideas. Federal Reserve finally approves. During August of 1995, the Federal Reserve Bank of New York published a staff report under the title, Head and Shoulders, Not Just a Flaky Pattern. The report was intended to examine the validity of the head and shoulders pattern in foreign exchange trading. The first edition of this book was cited as one of the primary sources on technical analysis. The opening sentence in the introduction reads, Technical analysis, the prediction of price movements based on past price movements, has been shown to generate statistically significant profits despite its incompatibility with most economists' notions of efficient markets. Federal Reserve Bank of New York, C.L. Osier and P.H. Kevin Chang, Staff Report 4, August 1995. A more recent report, published in the fall of 1997 by the Federal Reserve Bank of St. Louis, also addresses the use of technical analysis and the relative merits of the efficient market hypothesis. Technical analysis of the futures markets was again cited as a primary source of information on technical analysis. Under the paragraph titled, Rethinking the Efficient Markets Hypothesis, the author writes, "The success of technical trading rules shown in the previous section is typical of a number of later studies showing that the simple efficient market hypothesis fails in important ways to describe how the foreign exchange market actually functions. While these results did not surprise market practitioners, they have helped persuade economists to examine features of the market that might explain the profitability of technical analysis." Conclusion: if imitation is the sincerest form of flattery, then market technicians should feel very flattered. Technical analysis is practiced under many different names, and often by those who may not realize they're using it. But it is being practiced. Technical analysis has also evolved. The introduction of intermarket analysis, for example, has changed the focus away from single market analysis to a more interdependent view of the financial markets. The idea that all global markets are linked isn't questioned much anymore either. That's why the universal language of technical analysis makes it especially useful in a world where the financial markets, here and abroad, have become so intertwined. In a world where computer technology and lightning-fast communications require quick responses, the ability to read the market's signals is more crucial than ever. And reading market signals is what technical analysis is all about. Charles Dow introduced technical analysis at the start of the 20th century. As the 20th century draws to a close, Mr. Dow would be proud of what he started. End of chapter 19 and end of book.
Thank you for tuning in and listening to this audiobook. I appreciate your time and dedication to improving your trading knowledge. Remember, trading success comes from continuous learning, discipline, and practice. If you found this audiobook valuable, don't forget to like, share, and subscribe for more trading insights. Your support helps keep this channel going and allows me to bring you even more valuable content. Wishing you all the best on your trading journey. Stay focused, stay patient, and keep learning. See you in the next one.